Hello and welcome to today's video. Today's video is going to be about the 10 biggest myths that exist around stock markets and investing. And we'll try to look at each of these myths and then demystify them so that all these misconceptions and rumors that are out there are basically clarified and people can really focus on the actual real stuff that makes sense. So we'll take a look at the 10 myths and we'll try to demystify them here. A quick look at the disclaimer before we proceed that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please make sure that you are getting in touch with a certified financial advisor and you understand the risks before trading or investing. One quick call out is that I'm sharing my trades, the ones that I take for myself, free of cost on my YouTube channel under the community tab. So you can actually go to the community tab and access these trades for free. Usually, people charge money for sharing their trades and providing this kind of a service, but right now I'm providing these trades for free, and we also track the overall profit and loss in the account as a result of these trades. So there are lots of trades available, and you can subscribe to the channel and enable the notifications. And what that would allow you to do is that as soon as I post a trade on the community tab, you'll get a notification for that, and then you can go and check out the trade. And I think it should form a really good learning experience.
In order to get my trades for free, you can just go to my channel, Serene Trading Strategy, and once you're on the channel homepage, then you can go to the community tab over here, and here you can see that all trades are listed. So till now, I have posted 41 trades, and some of these will show in the open status, which means this is an active trade, and I have still not closed this particular trade. Whereas some trades you will see will be closed. So these are older trades which have been, these positions have been closed. And so we have multiple open and closed trades mentioned here on various symbols that I have taken. And also for the close trades, what was the return, whether it was a profitable trade or a losing trade? What was the annualized return? How many days were there to expiry when I took the trade? And actually, the trade was open for how many days? All those statistics are mentioned here. We also keep a track of the running loss or profit. So right now you can see this is a positive number. So there is a $4,052 profit till now. So if you want to follow my trades, you can follow this process, and hopefully you will find this helpful.
So let's look at the first point, which is the myth is the high risk means high returns. And this is one of the biggest myths out there, that in order to make a lot of money, you need to risk a lot of money. And this is not actually the case. If you look at the very concept of value investing, it is all about investing into companies which have a really good business model, which are highly profitable, and which are trading at a deep discount. So you can think for yourselves that if you can identify the right companies and you follow the value investing approach, then you're actually investing in companies which have the least risk of insolvency or bankruptcy. You're investing in companies which have the highest margin of safety, which have the highest probability of being successful in the markets because of their moats and because of their management. So, if we select the right companies, then actually the lowest risk companies can provide us with the highest returns. So, high risk implies high returns is not something which is valid for the stock markets. A lot of people will tell you that in order to make big in the stock markets, you need to risk a lot of money. Well, that's not the case. If we trade and invest our money properly, then through risk management, we can reduce the risk or the maximum downsides in our accounts. We can keep reducing our cost basis by using options. So you can watch the rest of my videos. If you go through rest of the videos on my channel, you'll see that I talk a lot about selling option premium, and that is all about reducing your cost basis. So essentially, if I look at this point, high risk does not actually mean high returns, and low risk doesn't necessarily mean low returns. So you can get decent returns with a very low amount of risk, and the returns will be substantially higher than that you will get on fixed uh, income instruments like the treasury yield or the certificate of deposits. And at the same time, the risk is not that high, uh, that you will eventually lose your money. So we can mitigate the risk through various things like diversification, through proper money management rules. And so this is the first myth that I wanted to demystify. If you look at the trades that I have taken, you will see that in some of the trades, in some of at least the example trades, there is a playlist on my channel with the name live trades. If you go through there, you will see that some of the trades I have had 50% margin of safety. That means the stock could fall down by as much as 50% and I would still not start losing money. So with that kind of margin of safety already on a beaten down stock, obviously the risk is pretty low. So I'll stop here with this point. You can watch the rest of the videos, and if you have any doubts or queries around this, you can always let me know. And I'll also leave a link to the relevant videos on my channel, which further enforce this concept. I'll leave those links in the description, and you can watch those videos separately as well. The second point is that a lot of people feel that when you have to get started in the stock markets in order to make any returns, you need a lot of capital. So this is again not true, because one thing is that with the advancement in the uh, uh, platforms that the various brokers provide, the incentive for all brokers is to have more and more retail traders on board onto their platforms. And so there is a concept of fractional shares now available. So even if you have like $10 and you just open a simple trading account, you can actually buy fractional shares on a lot of trading platforms. That means you can invest into a stock that is maybe a $1,500 stock or a $2,000 stock if you just have $50 also, because instead of buying a complete share of $1,500, you will get fractional shares. So getting started into the markets is not at all difficult, even if you're into options trading. So with options trading, you have to deal in lots of 100 shares. So even if you have a very small trading account, let's say $2,000-3,000, then you can effectively trade uh, options as well. Because let's say you have $3,000 in your trading account and you want to take about three positions at least to have some kind of diversification and mitigate your risk. Obviously, with a $3,000 account, you can't fully diversify your account with the ideal 8 to 10 positions. But let's say you decide to take three positions, then you can allocate $1,000 to one position, and that means you can trade stocks which are $10 or less. And if you go and check, there are a lot of good companies which trade at $10 or less. The main concept here is that you need to be able to identify these companies. So I'm not talking about penny stocks, which are kind of illiquid and which have very small market capitalization. I'm talking about big, good companies with huge market capitalizations, and in fact, in some cases, they are the market leaders. If you go and check, for example, Ford's stock price some time back, it was trading under $10. Right now, also, you have a lot of stocks which frequently trade below $10, and you can trade them, and you can have pretty profitable trades there, even if you're into options trading. And if you're not into options trading, you're investing directly into stocks, or you're trying to build a dividend portfolio, then with the fractional shares being available now, you don't need a lot of money to get started. So obviously, investing and stock markets is not for only the high net worth individuals or the hedge funds which manage a lot of money. It is there for retail investors as well. And as we are moving forward in time, the brokers themselves are putting in a lot of effort to create the necessary tools, to create the necessary platforms which allow more and more retail users, even with small trading accounts, to be able to invest in the stock markets. The third thing is stock market is only for experts. So the way I would want to demystify this particular myth is that yes, if you want to learn how to invest and trade, there is a learning curve and you need to understand some concepts. So to start with, you need to understand the basics of the three financial statements that every listed company it generates: the balance sheet, the income statement, and the cash flow statement. So you need to have a basic understanding of these financial statements and understand some of the key figures like price to earnings, price to book, what is the book value, what is the debt to equity ratio. So these terms have to be understood. But if you really ask me, if somebody has basic elementary education and if you were able to complete that, There is nothing like rocket science which you cannot understand or which you cannot learn within maybe 3 to 6 months. So somebody may learn it within a week, somebody may take maybe a year to learn it, but it's something which is doable. And as far as experts are concerned, you can look at the portfolios of a lot of professional fund managers and they lose a lot of money. So the entire concept here is that the so-called experts can also have bad times when they can lose money. In fact, they can have a succession of bad years when these funds are losing money, and this is professional money. People who are supposed to be experts and kind of managing money for the other people, they tend to lose money a lot of times. So, uh, if you're just getting started and you don't have too much of an understanding, you can get started simply with a dollar cost averaging of an index fund, and that itself will give you pretty good returns in the long run. So, your investing and trading approach can be very simple based on your expertise level, and as you learn more and more, you can get into more advanced trading and investment approaches. So, on this particular channel, I have a lot of videos where I have covered the various concepts from right from how do you come up with ideas or the trading ideas or the concepts, that where do I start looking for opportunities. So I have a video around that. Then I talk about various screeners, that once you have an idea, let's say you want to look at undervalued companies, then how do you identify uh, those undervalued companies using a screener. So I use Finviz, and I basically have a lot of videos around various screeners which can be used to come up with a short list of companies which satisfy different criteria, like stocks which have a strong balance sheet, or stocks which are undervalued, or stocks which have undergone a huge correction recently. So different screeners I have already discussed. And then I have a lot of videos on my channel which talk about selling option premium and how I create multiple cushions or layers of protection in order to take those trades and be on the right side of the trades. So if you look at this process, if you look at all the videos, you will understand the overall system, because trading is not about just buying or selling shares or buying and selling options. It is about creating a complete system which involves your risk management, your money management, diversification, uh, why you need to have a small portfolio of stocks which give you dividends. So these are important for times when you are not getting growth returns from the stocks. Then dividends play a very important role in generating some amount of cash for you. So all these concepts have been covered in multiple videos on my channel. So you can start with a very simple approach. As I said, you can start with an index fund kind of an approach. A lot of people do that, and you can keep dollar cost averaging on that. Or as you learn more, you can get into more advanced concepts. So stock market investing is not just for experts. Even beginners can get into this. And the only thing is you have to keep your principles and guidelines very simple, which are easy to understand and which make logical sense to you. Just don't follow a set of lines somebody is randomly drawing on the charts and says the price is going to go here or it's going to stop when it reaches this level. Unless it makes logical sense, unless you understand the concept behind it, do not follow it. Keep your trading process very simple, and if these basic guidelines are met, you will see that you can have a lot of profitable trades. The fourth thing that I want to call out is that a lot of people feel, and especially there's a generation of folks that feel that stock market is similar to gambling. And a lot of times this comes from a bad experience that one has had during a crash or a depression, where people themselves or their family members or friends, somebody has lost a lot of money, and they feel that stock market is nothing like. Uh, it's not about investing, it's just like gambling. And this is not correct, because when you're gambling, you're totally dependent on your uh, the probability of the odds being in your favor and the odds being against you, whereas your skill set plays a minimal role. It's the kind of cards that are dealt to you, for example, or the kind of where the ball lands on a roulette wheel is totally a game of chance. Whereas in the stock market, uh, when you are investing in stocks, you should consider that like buying a business. So there are good businesses and there are bad businesses, and you can identify the nature of these businesses based on their financial statements and how these businesses are basically performing uh, till now, and what is the future potential for these businesses. So you can actually walk into, let's say you are going into the clothing segment, so you can walk into 5 or 6 different clothing retailers, and then you can see the difference in their brands, in the kind of clothing they prepare, in the kind of pricing they have, and that will immediately give you an idea that if out of 5 or 6 clothing retailers I was to pick up one or two in terms of their products, in terms of the quality of service, in terms of their pricing, I would pick up, let's say, these two. And if you go and check their financials, and if you go and check those companies as investment opportunities, you would mostly find that the two retailers that you identified earlier, based on their products, based on their service, are the ones which are where the companies are also doing extremely well. So it is not as gambling, because you can apply a lot of logic, you can apply a lot of analysis, which makes actual sense, and these are more of business decisions. But as long as you see the stock market as a place where you just don't try to bet money on a stock going up or down, but rather you start to learn to own businesses and identify businesses that have really good intrinsic value, which have really good moats, and which have great managements who run the company, then you're investing, not just you're not just throwing money on a game of chance, rather you're making a very, very calculated, and you're making a very well thought kind of a bet, that you're investing in something which has intrinsic value, and you're investing in a good management, so your money is going to grow with them. So stock market is definitely not the same as gambling, and so don't just get bogged down by somebody's experience. Somebody may still believe, strongly believe, that this is the same as gambling because of their own personal bias, but you should look at it from a fresh perspective. And in my opinion, stock market is definitely not gambling. Yes, institutional players do control a major portion of the market, and they can manipulate the prices up and down. But in the long run, it is the value investing will principles will hold, and no single institutional investor will be able to continuously pump up the price of a stock or continuously depress the price of a stock. If the stock is good, it's a good company. No matter how low the price goes, eventually it will recover. The fifth misconception is that stock trading is now ruled by algorithms. So algorithms means that instead of people making the trades, there are a lot of bots or programs which are actually trading, and this is to a certain extent true. But uh, to say that the retail trading or the manual trading or people do not actually trade at all, that is wrong, because the algorithms which are used for trading are for very short term purposes. So very high frequency trading, where trades are just held for a couple of seconds or even microseconds in certain cases, yes, those are run by programs. But if you have a trading style, or you have an investment style where you're holding the stocks or positions for, let's say, a couple of weeks, you're into swing trading, that is something where you will mostly be trading, the overall strategy is not implemented by bots. So there is a lot of trading and investing that still happens out there, which is not related to bots. And in fact, to a certain extent, the availability of these programs and bots is a good thing, because it brings a lot of liquidity into the market. So understand that if you're trying to sell and buy shares, you always need to have a counterparty. So if you're trying to sell, somebody else should be willing to buy. If you're trying to buy, somebody else should be willing to sell. And these automated algorithms, they actually look for very, very small profits, but on large volumes. So because they trade in large volumes at almost all prices, they bring in a lot of liquidity into the system. And this in no way should hamper your ability to make money in the markets. So if you have any doubts, you can look at the trades that I have taken. I have almost 40 plus trades listed on my community tab of my channel, and that is a proof that you can actually make money in the markets. Even when the overall markets were crashing, I was profitable. You can check out the trades for yourself, and you can backtrace them to the days that I have mentioned, and you will see that although algorithms may be out there, but they don't hamper your ability to trade and be profitable in the markets. So let's move to the next point. So this is a big misconception, and this is where a lot of people lose a lot of money. There is a big misconception that a stock that is going up, it'll keep going up forever, and this is never the case. So you have to understand that once a stock starts going up, first of all, there has to be a reason for it to go up. Sometimes it can be a genuine reason that the underlying company is doing really well, it has really good future prospects, but sometimes it's just hype, rumors, which pump up the price of a stock. So if it's the latter, then eventually the stock price is going to crash. And you have to understand that a stock price that is going up will not keep going up forever. It will eventually correct. And in fact, a stock that has already gone up in price by a lot of by a huge amount will not continue going up, and eventually it is going to come down because somebody is going to start taking profits. And if the stock price doesn't deserve to be at a higher point, eventually there will be a correction. So don't believe that if a stock has been going up for the last 2 years, it is going to continuously go up. Look for the underlying reasons. If those reasons still hold, then the stock price is probably going to continue going up. But if those reasons are no longer there, or if they never existed, then you are due for a big correction. So let's not just assume that a stock that is going up will continuously keep going up. This is the opposite of the previous point, which is that a lot of people feel, and they basically build a trading strategy around it, that if a stock is beaten down 50-60%, it's going to go up. Again, this is not true, because you have to really understand the reason why the stock fell down by this amount. If a company is doing really badly and it's going towards essentially a bankruptcy, then there is nothing that can save that company. And the stock price is reflecting just that, the miserable condition of the company and its inability to probably survive in the future. So, a stock which is beaten down need not necessarily recover. Yes, good companies, when they are beaten down because of the market sentiment and over fear in the market, those are really good trading and investing opportunities. But that doesn't hold true for every single stock. You have to differentiate between good companies which have been discounted as against bad companies which are losing their valuation because of genuine reasons. This is a big misconception again, and a lot of market so-called gurus, they will try to predict the market bottoms. And I see so many gurus on TV and on YouTube channels and on different platforms calling out that, this is going to be a bottom, this is going to be a bottom, and eventually those bottoms never hold. So, in my experience, if you want to take my verdict, there is no, it is impossible to exactly determine the market bottoms. Yes, you can take a fair idea based on what's happened in the past, but then history is always being created, right? So it's not going to help anybody if you believe that you can time the markets, or you can exactly figure out the market bottoms. So whenever you're trading, let the markets do whatever they are trying to do. We as traders and investors just need to follow the price action. We just need to follow the macroeconomic conditions and the conditions in a particular sector and the conditions in a particular stock. So that is all we should try to do, because the markets are not going to behave based on what we feel it's going to do. Rather, we need to catch the pulse of the market and then accordingly take our trading decisions. One of the important concepts that I teach or explain a lot of times in my videos is that you need to create a lot of cushions, multiple levels of cushions. So let's say you felt that the lowest price for a stock is $100. It's right now trading at 120, and you felt the lowest would be 100. But in if I was trading this kind of a stock, I would actually sell the 80 puts and collect maybe $2-3 of premium. And so what this would allow me to do is, first of all, my buy price is going to be at 80, so the stock can fall from 100 to 80 further, and there also I will collect that $2-3 of premium, which will further give me another level of cushion. So my loss starts even loss starts only if the stock price falls below 77 $78. So you need to create these multiple layers of cushion. You can watch out my other videos to understand these concepts in more details, but do not try to time the markets. Don't try to find the exact bottoms in the markets. It's a futile exercise. You may be successful once in a while, but understand you're not successful. It's just a matter of luck that you were able to figure out the bottoms correctly. There is no set logic or formula which can tell you where the markets are going to bottom out. Next concept is that a lot of people feel that more diversification is actually good for your portfolio. Now, diversification to a certain extent is good. I firmly believe that having 8 to 10 stocks in your portfolio is a very good mix, because that allows you that a situation where you don't have to allocate more than 10% of your capital to a single stock. So if one stock is not doing well, you don't take a big loss that the rest of the stocks cannot recover from. So this is a concept of risk management, that you should have somewhere between 10 to 20 stocks in your portfolio, so that the allocation per stock is not more than 5 to 10%. And that doesn't mean that you should invest in 500 companies, because number one, if you do that, it's going to be very difficult for you to identify 500 opportunities, unless you are investing in a index fund or something. And even if you invest in index funds, uh, For beginners it's a good thing, but for experts it's a losing proposition, because when you're buying the index, you're essentially buying a piece of all the 500. Let's say you're buying S&P 500 related index fund, then you're buying a piece of all the 500 companies, and all 500 companies in the S&P 500 are essentially not good and not undervalued at the same time. So you're buying some of the bad companies as well, and you're buying some of the companies which are okay or good, but they are expensive right now. So rather than doing that, a much better approach which can give you higher returns is to pick up individual stocks which are undervalued and which are good companies. But diversification should not be converted into over diversification. Over diversification is going to give you mediocre results and it's going to reduce your returns. The last point is that a stock that has done well in the past is a good buy for the future. So this again um, is a misconception out there, that just because Coca-Cola or just because Microsoft have been doing really well for the last 15-20 years, they're going to continue doing well in the next 15-20 years. Well, trends can change very often, and also there can be a lot of accounting kind of gimmicks happening in the various companies. I mean, think about Enron, think about Lehman Brothers. Before these companies went bust, these are extreme examples, but before these companies went bust, these were at the top of their game. These companies were considered to be the market leaders. And then you can look at other companies like Kodak or other technologies that went out of business over a period of time because new partners, new competition came in, or new technologies emerged. And so it is not prudent to believe that a stock which has done well in the past will continue doing in the future as well. For example, right now, if you look at the oil and petroleum stocks, they're doing pretty well. But now there is a gradual shift from the fossil fuel energy to green energy, and unless these same companies invest a lot of money in building infrastructure towards green energy, they are slowly going to get phased out. They will lose in the market competition. Same thing with auto manufacturers. If you see, now there is a lot of emphasis on electric vehicles, which was not the case earlier. So companies which will either migrate to electric vehicles or adopt electric vehicles over the next 5 to 10 years will continue to exist and will continue to thrive. But companies which get uh, left behind in this race and which do not migrate to electric vehicles probably will lose a lot of their market share. So a stock that has done well in the past need not necessarily do well in the future. You have to look at the market conditions, you have to look at the approach of the management and the vision of the company, and then decide for yourself. So we covered a lot of points in this video, and I basically tried to clarify a lot of misconceptions that exist in the markets. And I hope this video was useful. If you found it useful, please share it with your family and friends. If you have any doubts, comments, or suggestions, please leave them down in the comment section, and I will definitely respond to you. And I'll catch you guys in the next video.